My name is Amit Kumar, and I teach finance at Rutgers. My book is called Short Stories from the Stock Market, and the book is about short selling aspect of the stock market. Short selling is selling a stock that you do not own. That is, you borrow from someone and you sell it, and naturally you're hoping that the stock would fall. And what you would do is you'd buy back the stock and return it back to your lender. As a short seller, you benefit when the stock falls. That's the only way you make money. So for example, if you think IBM, which is probably trading at $250, will go to $200. So what you're going to do is you're going to go out, borrow IBM shares, sell them at $250. And when the stock falls to $200, you buy the stock, you give it back to your lender. So you made $50 on that. In the meanwhile, you are holding on to the cash. So that's how you profit, doing short selling. If you're a manager, typically your clients tend to be more willing to share additional fees with you if you offer them a short product, because it gives them the impression that when the markets fall or when there's too much fear in the market, as a short seller, you can still make money. So you're not just relying on the long stocks. Now, the problem is there's a number of hurdles in this transaction. If your lender decides to call back the stock, then you have to essentially buy and deliver it to him, because the only thing we'll accept is the stock, not cash or anything else. There's a number of technicalities which are different from buying and hold kind of transaction. The risk rewards in short selling are very skewed, and it's much harder and very few successful long-term short sellers out there. I personally think this is more suited for institutional investors than individual investors, because they have a better risk appetite. They can construct their portfolios in a more risk-averse fashion. And also the institutional investors, basically, they understand when to cut their losses, when to get out, and they have more research horsepower. So short selling has been there since the 1600s, ever since the Amsterdam Stock Exchange began. So it's been around for a long, long period. And there's flavors, obviously, during the tech boom, it picked up again and again during the Lehman crisis, and now we are seeing a buildup of short selling activities as well. As I mentioned, short selling is a very misunderstood topic. Not only that, on the long side, you'd probably find a million books, on how to buy stocks, how to become, profitable, how to profit from stocks. But on the short side, there's very few books. I'm a professional stock analyst, and I'm looking for books on short selling to sort of broaden my own framework in sourcing short ideas. And I found very few. A couple of them were from the 90s, so the case studies were kind of old. Some of them were more technical trading. Some of them were based on sort of the accounting, earnings quality issues with companies. But none of them had a sort of a comprehensive framework as to how to go about and find your stock idea. And that's when I thought, maybe, I've got these case studies that I've been doing it for 7 years, and maybe put together my framework in a more cohesive manner in a book format. The book has about 30 odd cases, based on my own experience. It also has an interview with a short seller who's been doing it for about 20 years, so some of his own case studies as well. And we've tried to sort of fit them into the framework and the broad principles behind finding short ideas. So there is two aspects of short selling which we can think of as myths. Basically, one is that short selling is the opposite of buying stocks, and that's not true. There is a number of mechanics in terms of borrowing that borrowing introduces into short selling that I talk about and there's a picture for the process diagram in the book where borrowing kind of complicates the transaction. As in, you can be called back, you might have to cover at the wrong time. Number of things can happen. If there's a merger of the company or M&A of the company, then you have to, again, buy back at a much higher price, things like that. So that's one myth, that short selling is the opposite of buying stocks, and that's not kind of true. The second idea is, on the long side, you buy low, sell high. That works. On the short side, sell high, buy low, doesn't always work. So that's a myth. You might think that just simply because a company has a very high revenue base at, let's say, $20 billion, $25 billion, it cannot grow as fast as it has before, and it's trading at 5 times price to sales, 10 times price to sales. Maybe it's too expensive. I want to short it simply because it looks expensive, and that may not be reason enough to short sell. You have to really understand the business model and why they can go wrong before you can even think about short selling them. So that's the second myth I try to explain in the book, that sell high, buy low is not necessarily the mantra to short selling. I think naturally when you're talking about short selling, the first few names that would come to your mind is Enron, Lehman Brothers, a lot of companies which had accounting issues, and post-mortem it's very easy to explain what went wrong. But when you're trying to uncover the accounting issues, it's probably the most difficult task as a short seller. Just to short based on certain accounting discrepancies that you might have uncovered in a company may not be very self-conclusive. That chapter was hard because I had to look for data in terms of what kind of accounting frauds have happened in the past, where is the bulk of the problems lying. I talk about some of the key thesis to my framework, as in you short companies with broken business models. You never short companies with high valuations simply because they're trading expensive. These two important factors, looking for companies with flawed business models and not shorting companies simply based on valuations, often lead to good short ideas. The other places to look for is leverage. So companies which have either financial leverage in terms of too much debt they've borrowed and their demand for their products is declining, so their business probably is going to get hurt, or companies with too much operating leverage. For example, a company maybe which doesn't have any borrowings, but they have 200 stores and their products are going out of fashion, so they've got so much fixed cost and not enough money to sell, so they'll probably turn unprofitable. So those are some of the key points I've highlighted, and then there is also the idea of macroeconomic slowdown. So sort of the cycles, the business cycles, how to sort of look for the turn of the cycles, how they've turned in the past, and then look for sort of the cyclical shorting opportunities there. We all know Mark Twain, history doesn't repeat, but it often rhymes. And there was a number of cases I saw, as I've shown in one of my presentations as well, where markets tend to behave in a very similar fashion during crisis. And one example that I've cited was the way S&P 500 index behaved in the aftermath of Lehman bankruptcy in 2008, and the S&P 500 downgrade of U.S. credit rating from AAA to AA in 2011 September. So for the ensuing 1.5 weeks, the market followed the direction and the magnitude in an identical fashion. So if it moved 60 points up and 20 points down during Lehman, it did the same during S&P downgrade of US credit. The history rhymes aspect was, I think, very interesting. So the second edition of my book is going to include interviews with 2 or 3 additional prominent investors in the market who have very reputed track record, very strong stock market track record. Also, concepts of value investing and how you can tie it to short selling, as well as elements of behavioral finance. The book has got some coverage from bloggers, stock bloggers, and as well as local media. And I have presented on the book at a number of business schools and has been received very well by the students as well as the bloggers. So there's reviews out there, and the people who've been buying the book on Amazon have been also posting very favorable reviews. So and I've been getting emails as well from people who've read it and with kind remarks. So it's been received well so far. I think one key message I want to give to people through the book is, as a stock investor, short seller, or a long investor, you have to be a risk manager. So essentially, you have to think risk first. So hopefully, by the end of the book, when you want to buy a stock, you always want to think about the risks first. what can go wrong. And once you've got your arms around it, then you can always be a much better investor. Once you know your downside, you become a better investor. And that is the message I want to get through the book. So people become better risk managers for their portfolio.